Welcome back to the Deep Dive from NiftyNoon. We hope you had a fantastic holiday season and, from all of us here, a very happy new year.
Happy New Year. And it's good to be back.
It is. So for anyone just tuning in, this is where we take that whole stack of sources from our newsletter, everything from late December through the first week of January, and just, pull out the critical stuff.
And if you thought the industry took a break for Christmas, you'd be very wrong. Our sources were just overflowing.
It was nonstop. We saw huge market swings, governance crises that felt, frankly, existential, and some major institutional moves.
Moves that could really change the cultural conversation around all this.
It was a lot. So before we dive in chronologically, let's just start with the TLDR. If you're offline for those 2 weeks, what were the, say, 4 biggest themes we tracked?
Okay, the quick version. It was basically a massive tug of war. On one side, maturity and adoption, and on the other, a bit of self-destruction.
I like that framing.
First, we had major high-stakes governance crises. And I'm not talking about just drama. This was the fundamental tension between, the central company and the token holders playing out at Aave and Zcash.
Okay, governance. What's number 2?
Second, the industry slammed into a big regulatory wall. This was almost entirely because of Polymarket and these huge insider trading fears that got Washington's attention, immediately.
Right.
Third was this incredible institutional validation. And not just in one area. We're talking traditional finance with MSCI and high art, with MoMA making a huge move.
And finally,
a frustrating one. A constant reminder of security vulnerabilities and just how volatile the retail market is. The ledger breach and the wild RTFKT sale really drove that home.
that sets the stage perfectly. Let's start with that cultural validation piece, because it happened right before the holidays, December 22nd, and it felt like it came out of nowhere.
It was honestly monumental. When MoMA, the Museum of Modern Art, acquires something, it's not just a purchase, it's a stamp. It says, this is legitimate cultural history.
And they went big. They didn't just grab one piece.
No, they brought in 8 CryptoPunks and 8 Chromie Squiggles, all for their permanent collection.
16 iconic generative art pieces now sitting alongside, Picassos and Warhols. It's wild.
And it's important to note how they got them. This wasn't MoMA sweeping the floor. This was a donation from a coalition of, the heavy hitters, Larva Labs, Snowfro, Cosimo de Medici, Money.
Why is the donation part so critical?
Because by accepting it, MoMA is basically validating the entire provenance model. The on-chain history is now part of the artwork's official story. And then they put the pieces in their media and performance department.
Which means
They see the code, the generative process itself, as part of the artistic medium. It's the ultimate institutional nod. Just huge.
a huge feel-good story, which makes the contrast with what happened the very next day, December 23rd, even more jarring. The DeFi world just started to come apart at the seams.
Yeah, that's where the internal conflict really exploded. We saw this major dispute break out in the Aave ecosystem. It was basically Aave Labs, the company, versus the Aave DAO, the token holders.
And the first spark was about money, right? The stealth privatization claims.
Exactly. Token holders started realizing that revenue from a new CowDB swap integration was being funneled to Aave Labs.
Instead of the DAO treasury.
Instead of the DAO treasury, which is where everyone assumed it would go.
Yeah.
It raised this massive question of, who actually profits when the protocol grows?
And from a money dispute, it spiraled into a full-blown governance crisis.
It did, because Aave Labs then pushed a really critical snapshot vote through right when everyone was logged off for the holidays. It was a vote about transferring the brand assets, the domain names, the social media handles, to the DAO.
That timing just sounds deliberately hostile.
It felt that way to a lot of people. You're pushing a massive decision when community engagement is at its lowest point in the year. I mean, even the guy who wrote the original proposal, former CTO Ernesto Boado, he publicly called it disgraceful.
Wow. And the market reacted instantly.
Of course. The Aave e-token dropped more than 10%. And Aave Labs' defense was, we followed the rules exactly as written.
Which brings up the bigger question. Is this a failure of management, or is it a flaw in the DAO model itself, where the team that built it can just exploit it?
That is the multi-billion-dollar question, isn't it? It's the core tension in DeFi. Do you prioritize decentralized ownership, or do you need that centralized control to move fast and protect the brand? This whole mess proves that just having code isn't enough. You still need human trust.
And while all that was going on at Aave, another big governance vote was wrapping up, the Uniswap fee switch.
Yes, our newsletter flagged that. That proposal passed its threshold. This is a huge deal because it rewires the whole token's economics.
So for years, those trading fees just stayed in the protocol.
Right. But the fee switch changes that. Now, a slice of those fees can be diverted directly to the UNI token holders, the people actually governing the protocol. It ties the financial incentive directly to participating in governance.
Which should make the token more valuable and get more people involved. Makes sense.
Yeah, incentives matter.
Speaking of incentives and markets, that takes us right into the new year, when prediction markets became the biggest story for, all the wrong reasons.
Oh, yes. The Polymarket whale controversy. This was in our January 5th newsletter, and it's a perfect case study in regulatory risk.
Okay, so break it down. It all started with one wallet making a very, very suspicious trade.
A brand new wallet, too. It happened just hours before that surprise U.S. military operation that captured Venezuelan President Nicolas Maduro.
And what was the bet?
The wallet put down $32,500, betting Maduro would be ousted. The odds on that happening were just 6% at the time.
So a massive long shot. And they walked away with
Over $400,000 in profit. The timing was just too perfect. It screened access to non-public government intelligence.
I saw the speculation online, everything from serious insider trading talk to jokes about them tracking like Domino's pizza orders near the Pentagon.
Right, a classic market indicator. But yeah, jokes aside, the political reaction was no joke at all. It was immediate. Representative Richie Torres started drafting a new bill.
The Public Integrity in Financial Prediction Markets Act of 2026. What does it actually do?
It's pretty targeted. It aims to ban federal officials and employees from trading on these markets using non-public government info. It's a direct response to a decentralized market that operates outside the old financial rules.
It's the paradox of success, isn't it? The markets get so good at predicting things that they attract the kind of attention that could get them regulated out of existence.
Exactly. And the funny thing is, at the same time this was happening, we also noted a totally legitimate VOT on Polymarket that turned $900 into over $200K in profit. By legally scraping live esports data for games like League of Legends faster than the humans could react. So you have the machine being super efficient legally while the human was trying to exploit an illegal information edge.
What a contrast. Okay, so moving from insider threats to external ones, January 6th brought that big security alert about Ledger.
Yeah, and this was so frustrating for users. The breach wasn't Ledger's hardware or their software, which is what they're famous for. It happened through a third-party payment processor they used, a company called Global E.
So the crypto itself, the funds, were never at risk.
Correct. Ledger was very clear on this. Private keys, funds, the 24-word recovery phases, all totally secure. That's the whole point of self-custody.
But personal data did get exposed.
A lot of it. Customer names, emails, phone numbers, shipping addresses. Basically a perfect toolkit for a phishing scammer.
So the takeaway here is pretty stark. Your self-custody setup is only as secure as the Web 2 services connected to it. The blockchain wasn't hacked. A basic e-commerce partner was.
Absolutely. And if you're listening and you're a Ledger customer, you need to be on high alert for very sophisticated phishing emails and texts. Do not ever, ever give out your seed phrase. Your funds are only safe if you stay vigilant.
Good warning. And just to close the loop on that whole Polymarket saga, the Maduro market ended up being pretty confusing for people, didn't it?
It did. Because the U.S. military operation didn't technically meet the contract's specific definition of an invasion, the market didn't resolve the way many gamblers thought it would.
A good reminder to read the fine print.
Always read the smart contract fine print.
Okay, let's pivot now to the corporate world, because January 7th brought a huge sigh of relief for anyone holding strategy stock.
A massive one. This was a real threat. MSCI, which is this giant index provider, was thinking about kicking digital asset treasury companies out of its global benchmarks.
And just to be clear, that directly targets strategy.
It's basically the strategy exclusion rule, yeah. And if they got excluded, any index fund that tracks MSCI would be forced to sell billions of dollars of the stock. It would have been a catastrophe for the share price.
But that didn't happen.
It didn't. They blinked. MSCI decided against the exclusion, but, and this is a big but for the time being.
So it's a temporary reprieve.
Exactly. The stock surged 6% on the news, which was a huge validation for their whole Bitcoin strategy model. But MSCI also said they're launching a broader consultation, so the threat isn't gone, it's just paused.
So traditional finance is still trying to figure out the rules for this stuff.
They're grappling with it in real time, And at the same time, we saw Morgan Stanley file for both a spot Bitcoin and a Solana ETF, so the interest is only growing.
Right. And on the network side, we noted the Ethereum validator execute dropped to 0.
A very bullish sign. It means basically no one wants to stop staking and pull their ETH out, even while the line to get in and start staking is over 1.3 million ETH long. It just shows deep long-term confidence in the network.
That kind of stability is the complete opposite of what happened on January 8th with Nike and RTFKT.
Total chaos. This was a huge reversal. Nike had said they were going to just wind down RTFKT, but instead they suddenly sold the whole subsidiary.
To an undisclosed buyer?
Yeah.
And the market went wild.
Completely wild. The floor price for their main collection, Clone X, shot up over 200% in a day.
Why? Just on the hope that the new owner would be better than Nike?
Pretty much. This all fits with the Nike CEO's strategy of focusing back on physical retail. So the hope, the speculation, is that a crypto-native company bought RTFKT and is going to actually invest in its Web3 future.
And there was a hint from inside, too.
Yeah, the former CTO, Samuel Cardillo, posted a cryptic message online saying, "The story shall continue," which just poured fuel on the fire. It's another case of the community hoping decentralization can save a project from a centralized corporate strategy.
That theme of governance and structure brings us to our last major story, the huge shakeup at Zcash on January 9th.
This was seismic for that community. The entire team at the Electric Coin Company, the ECC, which is the main developer of Zcash, including their CEO, resigned all at once.
They said it was a constructive discharge. What does that mean in plain English?
It's a legal term, but it basically means your working conditions were made so unbearable that you were forced to quit. It wasn't a voluntary resignation in their view.
And the conflict was with the nonprofit board?
Right, the bootstrap board.
Yeah.
There was this fundamental misalignment, as they called it, over a pretty basic issue: taking on external funding to scale their consumer wallet, Zashi.
So the dev team wanted to operate like a startup, but the nonprofit foundation structure was too slow and bureaucratic.
Precisely. So they do something drastic. They forked themselves as a team. They immediately formed a new for-profit company called CashZ to do exactly what they wanted to do: scale Zcash to billions of users, free of all the political red tape.
The market hated it, I assume.
Oh yeah, the ZEC token dumped almost 16% immediately. But here's the paradox. This might actually be the best thing for Zcash in the long run.
How so?
Because now you have this focused, nimble, for-profit team that's unchained from all that bureaucracy. They can raise capital, they can ship product faster. Ironically, the split might allow them to finally achieve the mission the foundation was holding them back from. It's the triumph of agility.
It really is the push and pull we saw everywhere these past few weeks. Evolve, Zcash.
Yeah.
Everyone's struggling with whether you need a fast, centralized team or slow, decentralized governance.
And if you zoom out, that's the story of the whole period. You have this incredible external validation from places like MoMA and MSCI, but it's happening at the exact same time as all this internal political friction at Aave and Zcash, with the regulatory storm clouds gathering over everything else.
Success brings in the institutions, but it also brings in the regulators. That's the core conflict.
It is. And it leaves a really potent question for you, the listener, to think about as we move into 2026.
Let's hear it.
Okay, so given the wild legal success of that automated Polymarket bot and the very real difficulty that big centralized companies like Nike and the ECC had in managing these decentralized projects, how is this industry going to balance those two things? How do you balance the raw efficiency of automated trading and focused development with the messy political necessity of human governance and now inevitable regulatory oversight?
That balancing act is going to define this year, I think. Thank you for joining us on this deep dive.
It was a chaotic couple of weeks to break down, a lot to cover.
It was. If you found this useful, make sure you're following NiftyNoon on X and Substack. You'll get these insights sent straight to you every day. Until next time, we'll catch you on the next deep dive.